Good afternoon, everyone, and welcome to the third Investing in Germany online roundtable event hosted by REFIRE and Targa Communications. Today's event will focus on the German office market. My name is Andrew Barber, and I'm Managing Director of Targa Communications in London. And once again, as I don't speak any German, I must apologise in advance for any poor pronunciation. As usual, during the roundtable, we will be taking questions from the audience and would ask that you use the question and answer facility or the F&A facility on Zoom. We will try to answer as many questions as possible over the next hour. Germany's regional office market, particularly in the big 7 cities, have their own property cycles, and the outlook for the office market at a national level was difficult enough to understand and predict before the pandemic. With millions of office workers working remotely and staff keeping a safe distance from each other, the way in which the office is utilised by occupiers has changed dramatically in recent months. Many observers believe that the shift in working patterns and practices may well prove to be a sea change for the sector and raises the question, how will businesses occupy office properties post-pandemic, and what will the impact of COVID-19 be on the office investment market? To examine the impact that COVID-19 is having on the office market and to discuss the prospects and opportunities, we have assembled a highly experienced panel of experts for you who over the next 60 minutes or so will be providing you with their considered thoughts on the subject. So let me introduce them to you. Firstly, we have Diane Becker. Diane is CEO at Catella Property Germany, the property and finance specialist. Based in Frankfurt, Diane joined Catella Group in 2001 and has been the company's head of international investment since 2007. Next, let me introduce to you Paul Muno. Paul is Managing Director at Principal Real Estate Europe in Frankfurt and has more than 25 years experience in the real estate sector. He first joined the business in 2013. Our next panelist is Professor Jan Mutel. Jan is Professor of Real Estate Economics at EBS University in Frankfurt, where he has been working since 2011. Jan has studied extensively in the fields of real estate, macroeconomics, international economics, and statistics. Our final panelist is Sebastian Schubel. Sebastian is a founder and managing partner at Montano Asset Management in Munich. Montano is an independent asset manager focused on German commercial real estate for international clients with a particular focus on the office sector. Finally, I would like to introduce our lead moderator today, Mr. Charles Kingston, who is CEO and publisher of REFIRE, the online publication about German real estate for international investors. REFIRE is focused exclusively on reporting about the German real estate market in the English language and was first published in January 2006. Without any further delay, I will ask the panelists now to activate their cameras, and I will hopefully hand over to Charles, but Charles is having a few technical problems at the moment.
I just need to have my video started, Andrew.
Okay, so Charles is here. Perhaps I could start off and ask Diana, perhaps to give us a quick overview of your of the business at Catella and your experience, please.
Yes, good afternoon, everyone. Catella is a property group with services on financial advisory, transaction side, and also asset investment management side. I've been with the group, as you said before, I've been with the group since 2001, working for almost 20 years in Paris, on the French market, and in Germany since 2017. The group is present in 14 countries. We are about 550 people working for the group. And I've been working on the investment market in various countries with mainly international clients, Germans in France and French or Anglo-Saxon in Germany.
Good. Andrew?
Okay, well, perhaps I could also ask Paul Muno from Principal Real Estate to introduce yourself to the audience and give us a quick overview of your experience and Principal.
Okay, thank you, Andrew. I'm working for Principal now for a couple of years. We were beforehand Internos partnership and purchased by Principal roughly 3 years ago. Principal for itself as an insurance company with a huge investment management arm. The insurance company has roughly 600 billion under management, and only the real estate is 80 billion of assets under management, which is, I guess, part of the group of the 10th biggest investment managers for real estate in the world. We have offices all over the globe, and with the purchase of us, we have now 8 offices in Europe and handling predominantly European institutional investors and help them to invest in real estate in Europe or in the rest of the world. I am now in the industry for more than 2.5 decades, doing all kinds of investments, predominantly office, logistic, and retail, a little bit of healthcare. And with my friends in London, we do a lot of hotel business.
Thank you, Paul. Sebastian, could I ask you also to give a brief overview of Montano and your experience, please?
Thank you, and thank you for having me today. I started a career at Reed Asset Management, which is today BMO Real Estate Partners. And in 2013, I had the opportunity to start Montano with a partner. We are an independent asset and investment management company focused on the German market. We have a portfolio 80% invested in office and 20% in retail. Our headquarters is in Munich, and we've management offices in Berlin and Frankfurt. Taking care of today something like 1.6 billion in AUM.
Thank you. And then finally, Jan, perhaps you could give us an overview of your experience and what it is that you do at EBS University.
Yeah, thank you. Well, it's going to be 10 years in January this coming year that I'll be at the EBS. Big. I'll get a big piece of paper that I can put on my wall. But no, EBS has a large portfolio of executive education programs. We have a specialized master in real estate. And we have been involved in a lot of industry applied research on top of doing the regular job of being a professor, so teaching and doing research. My focus is on real estate. As you mentioned, I have a background in international macroeconomics and statistics. So I'm the one odd out. I don't have many assets under management apart from my 2 flats, but I bring the sort of the quantitative or the academic perspective. So that's my role on this panel, or my experience in the real estate industry. We've been involved because of our we are a private university, which is not very common in Germany. So we have been heavily involved with the industry, and I like that intersection between being on the academic side of the research, but as well doing things that have a practice relevance, as you would say in German.
Thank you.
Very good. Well, Andrew, if I can briefly introduce myself, I'm Charles Kingston. I'm the publisher and the editor-in-chief of REFIRE, Real Estate Finance Intelligence Report Europe. We've been publishing in English language for the last 15 years with the focus on the German real estate market. So we have a lot of readers and our audience is essentially international investors who are very focused on what's happening in Germany. So we report on their investments into Germany and also what German companies are doing here and from here out into the wider world. Today, our focus is, in this discussion, our focus is on offices. And I'm sure you've all had the experience in the last couple of months. Everyone seems to have a very clear view on all the other asset classes. So in other words, retail is bad and residential is bad and logistics is good. And the one thing that people don't know is what is happening with office. Is offices good? Is offices bad? And our goal this afternoon, over the course of, say, the next hour, is to try to get to the heart of what's going on at the moment in the market and where it is likely to go and what are the influences that are going to affect the market here, because we know that these are exceptional circumstances, and if anyone has any answers to where we're likely to be, where things are going to go, that's what we're going to try to tease out this afternoon. Just very briefly, Dan, I'd like to start with you. Let's all have a very quick little statement as to where the market is right now before we get into looking at where it might be going and what the influences are that could affect it. Let's have a little quick pen picture of the German office market from your view, Diane.
Well, it's if we start with the occupational market, the only figures we know today is the figures after the first half year of 2020, and what has happened on letting markets and what has happened on investment markets. And I think the overall observation is that in the first half year, we have lost about a third of the letting volumes that we've seen in the previous years. And if we look at the top 5 or top 7 German markets, I think the most successful market has been Berlin, and then Munich and Düsseldorf on letting transactions. Maybe we can talk about Frankfurt for a second.
Yes.
Frankfurt has seen a very difficult first half of this year, with over 50% less of letting transactions than the previous years. And of course, that is because the big transactions have been probably postponed. They start, I think what we've seen is that there is more activity in the third quarter, and we might see some big transactions coming out over the next weeks. Concerning investment market activity, there has been an extremely strong first quarter. The overall first half year result is approximately 25 million, out of which that is the commercial volumes, and out of which we've still offices as the most successful asset class on the market for commercial transactions.
Okay, and if I can briefly go to Paul there as well, who knows the market,
of course,
as well. Diana mentioned that Berlin is holding up strongly. Of course, Berlin traditionally, in the last couple of years, Paul, has had a very low vacancy rate. It's been very difficult to get office space here. Not always the case in Frankfurt, which has traditionally had a history of high vacancy rate. How do you see it?
I guess it's now the third or fourth time that Berlin starts to pick up, and I guess this is really the time where it's taking up. And if you take all the proptechs and fintechs and venture capital initiatives in Berlin, I guess this is really driving the city and creating much more attractivity for investors to be there.
Yeah. Sebastian, you talk a lot to your international investors. What are you telling them where the situation is at the moment? Now, remember, at the turn of the year, we were already heading into slightly dodgy territory before Corona came about. Isn't that right?
Yeah, absolutely. I think there have been some concerns already that, in the past years, Germany was always the safe haven, and there was no signs of risk. And I think with all these, probably question marks around automotive, there has been some questions around this safe haven, at least what we recognized, although there is still a lot of capital available, and there's still a lot of capital looking for investments. And I think this is what we still recognize. First of all, and second, I also think it has changed in the past month in so far that I think as a German population, as the society here, we manage the crisis quite good, and the feedback we get is that it's to some extent what people around the world would expect. We are very disciplined. We are taking acting by the rules, and that's the reason why we probably, I don't know, I'm not an expert in this virus, but why we at least for the time being coped very well with it, and that's the feedback that we get, because from a global perspective, what can you do? You can allocate. You have to decide where you make your allocations, and you see and you compare the individual countries, and I think by international comparison we did quite well so far. So what we see is there's still a lot of demand and still a lot of commitments to further invest into Germany.
Sebastian, finally, there's even a book with a famous title, Germans Do It Better, finally accepting that we can do it. And the UK is really reading this book and is creating a big fuss out of it.
They really are reading this book, Why the Germans Do It Better by John Kampfner. It's been an extraordinary bestseller. In fact, I have a copy of it right there, and I've just finished the first couple of chapters.
Happy to hear it. Yeah.
This is a man who, in fact, has lived in Germany. He was stationed even in East Berlin back in the old days. He's a long history, and he knows this market well. And that, you're quite right, Paul. That book, Why Do the Germans Do It Better, is causing great waves. Jan, I'd like to get to you. You wrote you yourself wrote an article a while back about the role of cities, in fact, and how the offices are in any way part of a whole process of change. And you see in some way the situation that we're in now as being, in fact, part of a cleansing process. Is that right?
It's right. And I may step back. The pandemic has created two kinds of dreams. One dream is the white collar dream, that they can move out into the countryside, get the white collar salary and doing the normal stuff. And the other is a nightmare for all the property owners and all the work which has been done beforehand in offices. And okay. I'm convinced that people will come back, because the advantage you have in big cities in regard of productivity and growth rates in productivity is something you can't put away. And I'm convinced that this will continue, and all the capacities cities have are still at the moment dormant, but they are still there. And we had in the medieval the plague and other pandemics, but the city life always came back. And I'm convinced that city centers will continue to exist, and maybe they will change. Maybe back office workers will remain at home because these are works which can be done at home, but the exchange between people, the sharing of ideas, the competition, the harsh competition in cities is highly requested. And after the pandemic, or after the competence to work with the virus, the city life will come back.
Actually, that's a very good point, Paul. There is a new study that has just come out, and this is the first time I've seen anything similar to this, because and it brings us nicely onto the point of productivity, which is something that is often forgotten in this discussion about working from home. There's two economists. Jan, you may know them, Jorge de la Roca and Diego Puga. They've actually tracked the movements of people between large and small cities, and have made the first attempt to quantify how much more productive people become by actually living in big cities. Tell us, do you know anything about this? Have you done any studies on this? But it's something that is only now, I think, beginning to be actually quantified.
Well, it's hard to quantify that, but I was constantly teaching urban economics class this morning, so I refrained from lecturing here. But it's just reaction to what Paul was saying. Large cities, the way that urban agglomerations work, from the point of view of these kind of new economic geography theorists, which those two belong to, is that there's agglomeration forces, which is the productivity of jobs that are located in clusters like banking districts, which are then more productive than others. But there are also costs like congestion or real estate expenditures, in the sense, because there's a limited space. If we take the situation today and we definitely probably going to talk a lot about commuting and sort of home office, if people don't have to go to the office all day, that makes actually the costs of living from the point of view of people, of the employees living in large agglomerations, lower. And that could actually lead in the end, in the long run, to further growth of big cities. So that's a benefit to both the workers and the companies, in a sense, that are in clusters, like banking districts in Frankfurt in our backgrounds. And that may make, in the long run, the cluster grow in size, and actually is not a loss. So what seems to be at the moment something where we lose demand for office space, it actually can bring also positive revitalization in the long run to city centers, because German cities have been growing on the expense of smaller cities. Right, and that trend is slowing down. This kind of movement in terms of how office work in these large agglomerations is organized can lead in the long run to revival of the cities, in the sense that it allows larger cities to sustain larger cities. Right.
Good. So, Diane, I know that you give a lot of thought to this as well, about as being the boss of Catella Property Deutschland, but you also have responsibility for a lot of staff, and you have offices all around the country. And you must be giving a lot of thought to this business about finding the right mix between having people come in, and at the same time, the potential loss of productivity by not being there. Although everyone says, and a Dreesen Sommer study recently said that 83% of people could imagine themselves working between 1 and 3 days from home. What is your experience about, is it too early to say anything about productivity yet in this situation?
I think a mix is extremely important with the possibility for people to have the exchange of information because they're sitting together and there is no time lapse. You know, it's quickly people hear this and then they say that. I think there is a lot of productivity on thought, on cooperation, on co-working, on various issues because people are sitting together. I think the 2 to 3 days, which you sometimes hear for people who want to stay at home, I think this is probably a little bit too much. There is a good example in one of the big occupation companies, which is L'Oréal. They have offices worldwide, and they have sort of forced people to come back to the office. You have a lot of companies where until the end of the year, they know they're working from home. But then from what we heard, L'Oréal has a different approach to that. And they start to attract people to go to the office again. And they ask them to go to the office, but they are not, they don't have to go back to their office. Mm-hmm. They have to work in the closest office they can get to their home. So they have a sort of a flexible work theory, and they bring people back to their desks, but not the ones they had to travel to for a long time. Let's say you have to commute for an hour and a half to get into Paris. So they give them the opportunity to gather in another office, which is probably in the periphery or in a smaller city, or even in Germany, they do the same. So that is quite interesting because that might lead to some of the smaller cities, metropolitan areas to grow. When you take Germany, for example, you've got very strong metropolitan areas like Nuremberg or like Rhein-Neckar.
Yes.
And eventually people could find offices or smaller office buildings even more regional than they were before. That might be for big companies a new solution as well.
Charles, we've had a couple of questions come in which are relevant to this.
Very good. Yeah.
Let's have you're going to have to give me a German lesson here on one of them.
Fortunately, we have plenty of German speakers on the panel.
Yes, just a chance to embarrass myself. But the statement is that a Mr. Schulten of Bullwingesa,
yes, Andreas Schulten, yes.
Is that a good pronunciation? Has previously mentioned that he doesn't believe in making a career from home. And would the panel perhaps want to comment on this regarding the 1 to 3 day working at home in the long run? And at the same time, we have a question from Libor Vincent. He says, do you agree that since Germany top 7 cities are by no means mega cities, office real estate will not be so affected as Paris, London, etc. by working from home?
Sebastian, why don't you kick off with that?
With regards to where do you make a career, when the going gets tough, you want to be close to, you want to have your team around, and I think that's a phase we're gonna enter now. So of course, if you stay 50 kilometers away from your employee and work your regular hours, it's probably not the way going forward to make a career. And probably that's the first job that gets redundant by AI or other technical developments. So personally, my experience or my opinion is you stay close, you are trying to become part of the creativity process. You try to add some value to the team, and then you're making a career. And that's not something you're going to do remotely. And nonetheless, 40% of our portfolio, of our office portfolio, is large-scale single tenant. So all the big corporates, Deutsche Telekom, Deutsche Bahn, and so on. And 100% of them are working on new working concepts. So I tend to disagree that there won't be any impact on the sector, because I think what now happens is that a lot of people get a voice, people which probably have not been involved in any decision-making process in terms of headquarter and office setup, and they now get a voice, and that will have an impact. Whether it will be positive or negative, I don't know, and I think it's too early to judge. But I think that we definitely going to see a change in the working habits, and yeah, that's.
I'd just like to make a quote here from, in fact, Jan, this will be of interest to you. It comes from one of your predecessors at the European Business School, Professor Rottke, who tweeted, and I'm reading this in German. It said, "Ich halte den radikalen Shift zum Homeoffice für einen der schwerwiegendsten Managementfehler und Leadershipfehler seit Gründung der Bundesrepublik. Mit einem Timelag von gegebenenfalls 18 bis 24 Monaten werden die Konsequenzen sichtbar. Büros ein Comeback erleben." Mm-hmm. What do you say to that, Jan?
Well, I think we're the wrong panel to answer these type of questions, right? So we are real estate experts, and we're not. If I have a question about productivity and organization of office work, I would actually like to talk to somebody who's responsible for that, which would be, and this is not an offense to us, I'm talking about myself as well. Maybe somebody who is a corporate real estate manager or HR expert who's actually organizing. So our tenants or your tenants. And of course, you have some ideas about that, because you do talk to your tenants and you have asset management, and that's sort of a secondary information. So, and I would also not make myself to a big management guru who knows how things are supposed to be. I don't believe that this work from home is going to be as extensive. I mean, we have heard these questionnaires. My partner, she has done as well a questionnaire in her company, which about 100 employees, a startup online retail in Frankfurt in Bahnhofsviertel, and it's similar answers. 2 to 3 days a week is the usual answer. There are extremes where somebody would say I only want to work 1 day home from 1 day a week from home, and some would say 4 days at home, 4 days a week. In the end, if you give people chance, and this is basically what they are going to do, is they will have completely flexible working hours, and it will be maybe 2, maximum 3 days of work from home. So we're not talking about such radical shift. And I do think that if you have the flexibility, you can actually realize some productivity gains. But again, this is going to be something that is hard to predict. I believe that given the flexibility, the acceptance for it as well, it's also a lot of legal issues that have to be solved. In Germany, and I'm not German, but as far as I understand the German legal system or the regulations, I would not call it home office. You have to be careful. Call it mobile working, because if it's home office, the employer has to pay and control the safety regulations at the Arbeitsplatz and this and that, and it's expensive. And so on. So call it mobile working, and you don't have to do that. So that's great. But that's a lot of regulatory issues that will get resolved, because this is now widespread, and that's a productivity.
Yeah, and I agree. We're not productivity experts in that sense. But no. Paul, you're an investor, and for you, knowing what your tenants are going to do down the line is obviously very important for you, right? I mean, this is, as an investor, these are issues now that you're having to make to know more about than you would have had to in the past.
Yeah, we have invested in offices all over Europe in the last, let's say, 10 years. And we have only one tenant asking for rent reduction or rent abatement over the crisis right now, because all others are using the offices as they have used them before and paying rent without any delay. So they will return back. And we have offices even in Milan and in Paris, where I guess they were shut down, but the tenants continued to pay their rent. And for that reason, we expected much more of a crisis on this end, but it didn't happen. Coming back to Mr. Rottke and his remark, I guess one thing is underlining this, because companies stopped hiring people, and even especially young people, because you can't train them on the job, because there is not any training possibilities, because you can't sit on a PC all the day and have video streaming. So this is quite an a difficult point to handle, which is, as you mentioned, something to be managed by the HR office. But this is what we see in the market right now. This will come back, but this is infecting. And the question in regard of mega cities, we do not have mega cities. And if you see the skyscrapers behind you, Diana and Jan, it's only a handful in Frankfurt, and most of them are still working. But if you have a 40 or 50 floor high-rise building in New York, you can't manage to bring your people to the office because it takes an hour or a quarter of an hour. And this is not manageable because people waste time. So unless the pandemic is not stopped, those offices will have difficulties. And I would not recommend to buy it right now. I would still wait. But at the end, it's still something where you should invest in.
Diane, from an investor's point of view as well, you must be looking at these human factors as well in terms of clients' behavior down the line.
I think, you know, when you ask yourself what is going to happen with occupation of offices, difficult question. You know that Catella has produced this study about home office and the effects on the occupation of areas, and I think that most of those who are trying to find a sort of statistical mass or something where we could predict anything, we all think that there is a probably 10% impact on the demand side due to the home office issue. But there are other issues where we have to face economic development over the next months and the next years. There are other questions. What does the demand do? What does the supply do? And where is the development pipeline? Because now we are in quite a good shape in Germany. We have low vacancy rates. We have a quite healthy economy. So the question is, what is really happening on demand, except home office aspects, because there are a lot of other aspects. And for the time being, we get the feeling that it's not too much affected, the German economy. But there are a lot of sectors where it can be dangerous on how much space does the company really need. So there is economic development on the other side. So there is, and that is going to be the interesting part in 2021. What is growth rates? What is development pipeline? Where do vacancy rates go? And that's where then the prices will start to react. So that is, I think, more factors than just home office on demand.
I think the what you mentioned there, the bigger picture of supply and demand will have an effect on rents in the short to medium term, and ultimately on investment values. And so far, rents, from what we hear, are holding up well. But there was a study recently by the Institut der Deutschen Wirtschaft in Köln, and they are actually predicting a collapse in top office rents. Now, top office rents are not average rents, of course. We all know this. They're talking about a fall of up to 23% by the end of this year. Is that scaremongering? What would the rest of you say? Are you seeing anything like this in the market at the moment? Yeah.
It was an announcement.
Paul. Yeah.
About the Crown investment, which is the properties of the Queen in England, and they have put down.
Paul's microphone is quiet. You've gone quiet, Paul.
Sorry.
No problem. No problem.
No, can't hear you.
Can you hear me now?
Yes.
Yeah. Okay.
Yes, Paul. Please go ahead.
The Crown announced last week that they put down values by 17%, and they are predominantly invested in London. And this is quite a harsh sign. 17%, it's not 23, but it's a harsh step down in values. And this may happen even in the bigger cities in the rest of Europe.
If I may add, I mean, I
please do. Come in, Jan.
issue to home office, I think this is something that might change the way business is conducted. So we see sort of a wave of digitalization, which home office is part of that. And that means that includes things like we do meetings like this, or more online. So you don't have such incentives. This is about location choice of the companies, of the offices for banks and insurance companies and so on. In the long run, this might actually reduce the incentives to be right in the middle of the banking district, and maybe consider well-connected secondary locations around that. So that is hitting the top rents much harder because you have reshifting within the same agglomeration. So put it in context of Frankfurt, moving from a skyscraper in the middle of Frankfurt to maybe a nice campus location in Niederrad, where you can build your own building like Becker Bank is doing, and build a huge campus where you actually put most of your employees. It's not really that bad back office location anymore because it's more like a Google campus feeling, right? So, and that's only possible, that will be more possible because of this kind of how productive you are as a part of a financial cluster. And for this, originally you have to be in Frescasse and have these meetings live and networking and so on. Those incentives are maybe perhaps in the long run reduced, which is the same thing, as the home office. Not only the home office, it's also how business is conducted. And that might lead to the reshifting, that can actually hit the top rents quite high. Even though on average for the city, it's not really a big hit, right? It's reshifting throughout the city.
It's a good point. Sebastian, as far as I know, 80% of your investment volume is into the office sector. So you're obviously watching all of this very closely.
Yeah.
Talk to us a little bit about the difference in quality. I mean, there's still a wall of money chasing these offices, isn't there?
Absolutely, and I tend to probably not disagree on the prime rents, but on the prime yields on core, we see that prices are rising on core, and that's for the reason that our central banks decided to move on with monetary easing, and there are still a lot of capital, fearing of inflation. And so real assets will gonna have their place in every portfolio going forward. And with less retail, with less hotel, logistics is a small market. You have to place it somewhere. So what we see is, and in the bidding process we participate, that prices for core properties, good quality, decent location, good quality tenant, prices are actually rising, and they rose over the past 2-3 months, and from my perspective they're going to continue to rise even further. But at the same time, what we're seeing is that risk comes at a cost. And for the mid sector and for the lower quality sector, the risk premium is increasing. So which has the opposite direction, prices should go down. That's the reason why, from my perspective, we don't see a lot of transactions, because sellers are not yet prepared to sell at lower prices, but buyers have to anticipate increased risk in terms of downtime, in terms of potentially lower ERVs in the underwriting. And to get to the same returns, you have to place a lower offer. So I think, or at least from our perspective, the range between the risk classes broadens. So you have constant core or even rising core prices, and you have decreasing opportunistic or value add prices, and that's what we at least see in the current market.
So you're saying actually that you, between the risk classes themselves, there will be a widening spread.
Exactly, yeah.
Okay, that's interesting. Diane, does that correspond with your experience? And Paul, both of you investors here? Diane?
Yes, of course. For example, when we say core, I think it even gets more important when the tenant, I mean, everyone is looking for cash flow security to get over the next 5-6 years. But I think as long as you have, to give an example for what Sebastian just told, I mean, when you have a state tenant, a German state tenant in a building which is in one of the top 7 cities and well located, I think that the yield compression is quite rapid from what we see, and it's totally true that it's difficult to see what is happening on transactions in regional cities where there is tenancy risk or where there is a lot of lease contracts to be ended in the next years because of pricing where vendors and buyers haven't found yet the equilibrium, I think.
So what will happen then? Will they come down in the rent, or will they sweep it under the carpet with incentives or other forms of bonbons?
You're talking about rents now.
For
I was
example,
talking about investment prices. Yes.
Yes, I mean obviously
So,
investment prices are a function of the rents of
yes,
the rents.
Yeah, of
But
course.
do we know what's going to happen? Are we seeing any evidence? And Paul, I'd be very interested in your experience on this as well. Go on, Diane.
Yeah, I think I haven't spoken to a lot of investors where negotiations or renegotiations have started, and I think Paul said the same thing before. In the portfolios for the time being, no, but it will be very, very interesting to see what's happening with rent contracts that have been concluded in 2017, 18, and 19, when we started to be in a very successful real estate cycle, so and economic cycle. So I think there's not a lot of evidence yet. Maybe you agree, Paul and Sebastian, but I think.
We kept hunting for the last months. We were hunting in Lyon, in Marseille, in Edinburgh, and in Madrid. So very nice before COVID-19 interesting cities. And we were always the second or the third. There's still massive inflow of capital in the market. And if you get high quality, good tenants, average WALT, then you have to pay a core price still in these crises. And this, we keep trying, but we need to have a certain value of yield, which we need to deliver to our investors. So we can't pay any price. So for that reason, we keep trying and wait. And on the other side, on the tenant side, at least on the office side, we don't see at the moment so much rent decrease and incentives.
Charles, I was going to say this is not really inconsistent. So when we were talking about sort of shifting to the secondary location, this was meant to be the Latin market, right? So you might see sort of in some of the secondary markets in the big cities a revival or shift towards that. Maybe rents in the top locations, in the top floors going down. But then on the other hand, you have this wall of money. So then when you talk about the capitalization of those rents, that might look exactly the opposite, because for various reasons, as COVID is being managed in Germany better, office spaces look good. Lots of different types of investors might come to Germany as a conclusion of political uncertainty all over the world, including US, UK, name it, and their management, COVID, their management of politics and everything else. And those international investors, I think this is a question to those that bring those investors from abroad, like you, Sebastian, where they want to come. And that would be maybe primarily the primary location. So those will be capitalized more, and you will see yield compressions. And in the end, that's maybe good news for everybody, if you put that together.
But it does raise the question as to what extent Germany may benefit from a Germany dividend. Paul, what you were talking about earlier on, the effects of books like this, it's soft, but it is in a troubled world. If it comes down to investing in either France or Germany, many international investors still under pressure to invest. Maybe what is the likelihood that they will give it an overly generous dividend to Germany in terms of investing? In other words, can Germany generally benefit from all of this? Diane. Yeah, sorry, Paul and Diane, but I know both of you.
Paul, please go ahead.
Paul, you go ahead. But then, Diane, I want to hear your views, because I know you've lived in France as well. You know that market extremely well. But Paul.
I guess Germany looks like a safe haven, and investors are recognizing this. For that reason, the focus to invest in Germany is there. And we see it in each sector, not only office, but all other sectors. Maybe not shopping centers, but all the other sectors are getting a lot of money which needs to be distributed.
Yeah. Maybe to add, I mean, it's true that when you talk to international investors, I think Germany is on top of the country allocation for investment product. But then very often, when you speak to them, they say, "Oh, we would like to, but it's so expensive." And that is, I mean, the positive and the negative of the success of Germany right now. And so a lot of investors are like you, they try and wait. But in the meantime, we know that we have a very strong national market, and we have very strong German investors with liquidity and interested in buying offices. And so I think, yes, there is certainly a premium paid for investment in Germany.
And there has been a surge, a noticeable surge, a withdrawal maybe of some foreign investors from the market, and the German investors, local investors, have stepped up to the plate to become much more active in the last 18 months. Among the banks, it seems that this is one of the categories that they're also still willing to invest in. But Sebastian, when you're talking to your international investors, and I think you've got some Asian investors as well, would they genuinely, seriously consider, or when they look at the European situation, and I'm afraid I have to mention the word Brexit as well, because it's looming, it's coming up very shortly. And while the UK market has traditionally been the biggest by far and the most liquid market, that's no longer the case. And Germany has stepped up now to take over from the UK as the biggest European market. And with the British out fundamentally at the end of the year, what are your investors saying about their European strategy?
Well, we only focus on Germany, so it's not that we are in an investment committee competing with other.
They could invest elsewhere.
Yeah, I think the biggest challenge for most global investors with Germany is that our market is not as transparent and not as easy to explain like in France or in the UK. You don't have London and Paris, and then with far distance nothing. In Germany, you have to explain. It's a more diverse market, which has a big benefit because it's more stable and more resilient to challenges. But at the same time, it's not that easy to come with, I don't know, 500 million of equity and invest it in one go as you could do in New York or other cities. So you have to make yourself comfortable that you have to spread your investments across smaller properties. We only have a handful of large-scale office towers, for example, as what we mentioned before. And also, I think in terms of transparency, you have some more challenges because our market, by international comparison, is just less transparent than other markets. And that's something you have to explain and accommodate. And I think if investors understand these underlying principles, then they are more than happy. And all our investors, which we started to invest back in 2012 and 13, they are still on board and still committed also to reinvest funds here because it's as I said before, very resilient and stable market.
I always find it amazing when people say something is less complicated than the French way of doing things. Is that out of line, Diane?
Charles,
no, I think to come back, I think Germany has gained some places in that transparency index, which we see. But still, I agree with Sebastian. It's such a big difference to more transparent markets, and to find market evidence is probably much more difficult here. Which is why it's so important to have good advisors.
Charles, we've had a couple of questions.
Very good, plenty of questions. I hope.
If I add one thing for the German sort of bonus, it's easy to quantify. You have the risk-free rate in Germany and UK and France, right? So negative 50 basis points in Germany, negative 15 in France, and positive in UK. That's the basis. Yeah. So if we talk about real estate, it's the risk-free rate plus risk premium for that, but the basis is sort of the riskiness of investing in that country, and that is Germany has a bonus. And it's quantifiable. It's 0.5%. Right? So sorry for interrupting.
No, very good point.
Very good point. True. Yeah.
And these are, I'm sure these are weighed up also by international investors as well. Andrew.
Okay, so a couple of questions. One concerning yields. German suburban office yields have been under pressure pre-COVID. Will they be even more affected now? Don't know who would like to pick up.
Who'd like to?
Yields.
Paul, I think you may have something to say on that.
No, I would give it to Sebastian because he has
Thank
more.
you.
Well,
yeah. I think it's too early to answer because traditionally in difficult times, the suburbs have suffered much more than the inner cities, and that's something that you would expect in a more difficult time. However, as Jan just mentioned, there are forces into other directions pushing out of the inner cities to the suburbs. So for me, it's really very difficult to predict. I think it's more important what is the type of quality of the property you have, because in the suburbs you tend to have older properties, lower quality, because rents are by nature lower, and you couldn't invest over the past years like you would have done in the inner cities where you can afford a refurbishment like every 10 to 15 years, and it still fits into your business plan. So that the quality of properties is probably lower on average, lower in the suburbs, and so it's important to be more careful in your selection. But whether they're gonna benefit or suffer, it's that's nothing I would be able to read in my crystal ball.
And perhaps the question can be extended from the suburbs to the big cities to, in fact, with the depth of the market that we have in Germany, to B, C, and even D cities, which are stories in themselves.
Yeah, well, I think 2/3 of the economic growth in the coming years will happen in the cities. It's not that we're gonna spread to the four corners of the world now for looking for lower residential prices and going away from. There's a reason why cities exist, and that has been for thousands of years, and that will come back. So I'm on the long run very bullish on investing in cities and in let's say suburbs next to the large cities. But yeah.
I guess what you can expect is less volatile markets in B, C, D cities. So they will continue to have 17, 18 euros or 15 euros per square meter, and not this kind of volatility you will get in high-rise buildings in Frankfurt.
Mm.
Okay, we've another question which has come in from Marcus Kreuter. This one, going back really to the occupational side of things as much as anything. It says, as banks and other heavily disrupted sectors will highly likely reduce demand for office space, which users will step in and take the space? How much space? And isn't that the question that we need to solve? Lots of nodding and smiling going on, Charles.
Yeah, who'd like to wade in there?
Probably I'm going to start in Munich. The largest occupier in 20 years ago was Siemens, and when Siemens decided to cut down space, everybody was afraid that we're going to end up with high vacancy rate in Munich. And what happened is that we have now a diverse structure. We have Apple and Google and Microsoft filling up these spaces. So there are new sectors coming to or increasing their footprint in Germany. So that's something that we already done 20 years ago, and I think it will happen again. We also in Frankfurt, when you have probably one or two banks leaving the inner city.
And also in Frankfurt, especially, the city has always reacted to high vacancy rates in offices. I mean, we've seen all these transformations of office buildings into mixed-use towers or into residential. So we might see a different not only use of offices, but a different use of existing space.
And what I can
to
see
keep
in
the cities alive.
Yeah, in the market is that developers are actually in the market reshaping developments and having hotels, residential and office and retail in one building. And this, I guess, will be the new mixture, and existing properties with growing vacancy will think about those schemes.
I think it's for me, it would be a question back to you, Diane. I think that the tenant mix has changed over the decades in Frankfurt as well. So Frankfurt has been much heavily dependent on investment or on banking industry as it is nowadays, right? So that change has already happened to some extent.
In Frankfurt, yes.
Yeah,
yes.
yeah. So,
yes.
so
A lot of yeah.
Similar
and
story
even,
as Munich, right? Yeah. So
yes, even if you look at the new towers which will be delivered and under construction, it's not only banks taking up the space. Big advisory companies. It's much more mixed.
Also, in answer to Marcus Kreuter's question, although the WeWork model itself may have become a little discredited, I think there's no doubt about it that co-working in some shape or form is definitely on the march. It's definitely expanding, isn't it? Diane, you mentioned earlier on about different ways of working. There are new models coming up where for example, I'm thinking of BASF's 1,000 satellites and so on. Where they're trying to overcome this business of enabling people to not just be living with the four walls and their roof crashing down on them at home, and it may not suit a lot of people, but also that they have a place to go to work, which may not necessarily be the head office of their company. And this does seem to be expanding throughout the market. That may be another use as well, Andrew. I'm just thinking, and of course, everyone is talking about the fact that offices are going to change. The nature of the office will change. That it'll be a place you go to network with your colleagues, to schmooze. I mean, this is not a nice time to be starting off your career and having to be told you're going to be working from home for the next 3 years. You know, so. Yeah, I mean, that's just one consideration, but we'll see how that develops. Any other questions coming in, Andrew?
Yes, we've had one from Jose Vegas. He says, what about debt? This is going back to last week, perhaps. How are banks and other financing financing at new acquisitions after COVID? Is it more difficult to obtain debt? And has the percentage of leverage reduced?
I suppose in respect of offices, right?
Yes, I'm guessing it doesn't say that specifically.
Yeah, who'd like to, Diane?
Yeah, what we hear is that the banks probably have lowered a little bit the LTVs. When you discuss with banks whether they have done some repricing or reevaluation on their office portfolios, or whether they have reduced their exposure to office, I think not yet. I think there is there has been a phase some weeks ago, maybe end of the second quarter, where it was a little bit more difficult. Refinancing for the banks was more difficult. But from what we understand now is that maybe instead of having 80% LTVs, right now you're more at 60%. But pricing has not really changed, I think, so far.
Germany is one of the most competitive banking markets in Europe, and you get very interesting margins still, even for office. It may be more difficult for other sectors, but office is still highly respected by banks, and they are offering interesting margins, which give you the opportunity to go for the very long, for 10 or 15 years.
I had an executive master student a couple of days ago who was writing his thesis on sort of mortgage banks, how they dealt with the low interest rate environment, in the sense it's not talking about Corona, but generally low interest rate environments. And what he was sort of analyzing out of the portfolio of an unnamed German mortgage bank is that the margins from the point of view of the mortgage bank has actually increased over the years. So the mortgage banks have been doing quite well on that. So these operational margins that they have for their cost and all that, they've been able to pass it along. So all these regulations, including Basel and everything, since it affected everybody, even in that competitive market, they were all able to pass it along to the customers. and because of that involvement of the risk-free rate or the refinancing rates, those offers looked very attractive to the investors as well, because you're getting great rates below 1%, but that doesn't mean that the bank is losing money. They actually have profit margins that have been stable. That's just the gist of that, of course, but and very single evidence from one portfolio.
That's a very good point.
But banks are not doing that bad as it seems. That's for mortgage for real estate banks. No, it's not for the commercial banks that might suffer because of low interest environment of their business model. But this is for the real estate financiers. So low interest rate has not hurt them in the past.
Yeah, Andrew.
Yeah, I have another question here about the some B locations and how attractive they are, such as Mannheim and Essen. They still benefit from strong local industry and service activity, but are they attractive from an international perspective?
Diane. That is, yeah, but that's more the question for international. So maybe Sebastian, I think they should be. They should be, because the underlying economies, local and regional economies, are extremely healthy, very often strong. Yes, and but on the other hand, it's difficult to find efficient investment volumes. So it's much easier when you have a client who has liquidities to spend in Germany. So it's much more efficient from investment point of view to go to the bigger cities and to have higher volumes to place. But maybe Sebastian has more experience.
Sebastian, as an idea to create a portfolio of several small cities, you can market it as a big portfolio deal. That would fly, wouldn't it?
Yes.
A funny story. We had one investor who came from London, and he said, "I'm gonna only invest in cities where I have a direct flight from London." So that cuts off.
Baden.
Yeah. No, I think it's more difficult to explain, and also I think it's more difficult to explain in terms of management, because especially in office, it's you need to be close to the property. So that's not you can barely manage multi-tenant office property in Mannheim, I don't know, for example, out of Munich, because it doesn't work. So you need to have decentral and local offices. But it's a nice market, and as I mentioned before, it's very resilient and very stable, and you don't have any. Most of the time, you don't have any speculative developments, and new developers competing for with nicer properties. So companies tend to stay longer, and we are investing in Mannheim. We are going to Essen as well, and
Bonn.
Same at our end. We are based in Duisburg, in Düsseldorf, in Mainz, so we are not afraid of the B and C cities.
So the volatility might be lower as well, right? That's what you were mentioning, Paul, before, that the volatility of the rents, the underlying rents as well. But what about liquidity? Is that something that I've been talking to some industry practitioners who were kind of thinking about liquidity. So is it more liquid if you have a big asset that takes time to sell in a top location, like top city, or is it more liquid if you have a smallest asset in Mannheim? And the answer, I couldn't give an answer to that.
Yeah, the big blocks like let's take 300, 400 or 800 million in one property in Frankfurt, I guess this is a very reduced marketplace where only a handful of international investors can deliver. If you are in the smaller markets with smaller lot sizes, there are even family offices interested in such properties. So we speak about 15, 20, 25 million, and which is highly liquid.
This is something that goes against the intuition that most investors would have. You would say liquidity in the top places in core locations should be higher, but it's actually, I agree with you.
It's more the international view, I think, because when you look at this year's market and this year's figures, you see that there is a lot of German investment in the B and C locations, in good products and smaller volumes. I mean, it's more difficult to find transactions above 200 million since Corona started. But there are a lot of smaller investment transactions in the regions.
And I guess there's something on the market I heard of. in Frankfurt for above 500 million with a weak tenant. And I guess this will be very, very difficult to get this over the line.
I think one of the interesting questions for this year will be, because I'm not sure we're obviously there will be a time lag before we know, but with the few deals of this sort of size that you're talking about, Paul, one of the big questions will be, we'll only know this later, what deals didn't actually take place, what transactions didn't happen this year, and it will take some time for that to filter through. Andrew, I'm thinking time-wise, we're at our limit unless there's other questions.
There's no other questions now, so I think that's. I mean,
maybe any of our panelists would like to leave us with a final thought. I
was going to say, has anyone got any predictions? Always good to hear and see people gazing at their crystal balls. Any predictions as to how long the pandemic is going to affect the market, and what changes you're expecting that you haven't already told us?
Maybe if I start with the past, so just put it in perspective, I've prepared this one chart. So may I show that, or is it?
Go ahead, Jan.
So the question is, before we start talking about the future, let's have a look at the performance of the different types of real estate throughout the pandemic. And of course, we don't have good data. So I look at the U.S. market, where you can look at the REITs and look at their stock market valuation, right? And then the question is, how did office perform relative to, let's say, warehousing,
yes,
or data centers? For this, you can see if I clean the stock market returns on the different REITs and then take averages over the different sectors. This is all the different classification you can get. The office is the thick red one, and the obvious things emerge, like data centers and infrastructure REITs have performed better than that gained value throughout 2020. So this is from end of January until today. Whereas, let's say, office REITs on average lost maybe 20% of their valuation on the stock market, which is still better than, let's say, residential REITs, which lost more. So office is not doing as bad compared to, say, the thick lines like residential and retail. So office as a sector, in terms of stock market valuation, and that has to be taken with, big grain of salt. This is in the US. So country that's been hit a lot by pandemic, hit a lot by political uncertainty and all that. So this is not Germany. Germany might look different, but still, office is not as bad. The second part of that analysis would be looking at volatility. So how uncertain are the stock markets about this valuation? And here, office is clearly something that's quite stable. So this is looking at the volatility of stock market returns of those REITs in that sectors, and office REITs are, of course, there's more volatility in the market. The biggest was in mortgage REITs. So you have seen some of the CMBS question marks. That's that part of the chart. That's the mortgage REITs, and consequently also the residential REITs, which are connected to that they also went up at that period in volatility. But office has been doing quite well. So that as an input to this, office as a sector in this context of looking at residential versus logistics versus industrial or resident or retail, office is quite preferred by the investors. We're quite sure about that valuation. This is up-to-date data, so this is something that is up to last week, and it's looking at investors valuing that, looking into the future, right? So you look at valuation of REIT portfolio, so that's something we can take and then now discuss how that looks in Germany and how is this sustained? Is this picture going to stay? So maybe flip back to that picture of value. We lost some value, but compared to, this is stock market values, right? So they all have lost.
Well, it certainly provides food for thought. We've somewhat of a slightly reverse situation here, in the sense that the stocks that have been prized most highly, actually, since the Corona crisis, have been the stock. We don't have residential REITs here, but the residential listed companies have more than made up for the initial shock, whereas other companies, listed companies that have got a very high preponderance of office are struggling to get back to where they were at the beginning. But it's a very interesting, and I know that there is a wall of CMBS trouble coming from the United States. We're not as developed in that segment over here this time around after the previous crisis, but it's an indicator that we don't know quite to what extent the American situation may influence things here. Of course, I don't know if any of you saw the first debate last night. I think it was a bit inconclusive, but there's only 5 weeks to the election, and who knows what that will bring. Unless anyone's got Paul, anything else to wrap up, or?
I guess cities will come back. The bigger they are, the longer it will take. And the German cities, they are not as big as US and Paris. Then I guess we will have a good chance to get our workers back in the office and start again with a higher degree of productivity in our offices. Good.
Sebastian, the final word?
Well, I think we had a lot of tailwind in the past 10 years, and it will become more challenging. But at the same time, I'm optimistic that we are not owning the steam engine and everybody's going for electric. So office will have a future, and it's not the worst place to be invested.
Indeed. And Diane, maybe a last word from you.
I think there's not a lot to add, and I hope that the office market will stay as attractive as it is still right now, even after the pandemic. And of course, I think what we have to keep in mind is also the development pipeline. So what do we do? What does the industry do with the supply?
Very good.
Okay.
Well, can I thank you all very much for very stimulating, very enjoyable discussion. Thank you all very much. This situation, the question will still go on. I've no doubt we'll still be asking ourselves very much the same things 6 months down the line from now. We'll have more data perhaps, but we're still in the eye of the storm, I suppose you could say. But thank you all very much indeed for a very, very good, very rewarding discussion. Thank you. And Andrew, if there's nothing else, I think.
No, if I could thank all four of our panelists, Diana, Paul, Jan and Sebastian, and also to yourself, Charles, for moderating this discussion. And if I could thank everyone for attending the event. It will be available to watch and listen to again online. There'll be links from the Targa Communication website. And we'll be holding more Investing in Germany Roundtables events, and we'll be announcing in the near future the topics and the panelists. So if I could thank you all again for your time. Stay safe. We look forward to you joining us again. And good afternoon to you all.
Thank you.
Thank you.
Thank you, everybody. Bye now.
Thank you. Bye.
Thank you.
Bye.